Components that impact cash flow. Now I'm going to try to break down to you some of the components that impact your cash flow and whether it's a positive or negative impact to your cash. Now first you have net income, and this is simply the starting point of cash flow statements. Then you have depreciation and amortization, and this is a plus because it adds back non-cash D&A expense. Next, you have an increase in accounts payable. This is also a plus to you. It adds back reported expenses that are not actually paid in cash. Next, you have an increase in other current operating liabilities or non-debt. This is also a plus. It adds back reported expenses not actually paid in cash or deferred liabilities. Next, you have an increase in accounts receivable. Now, this lowers your cash flow because it deducts the reported revenues not received in cash. Next, you have an increase in inventories. This is also it lowers your cash flow. It deducts the amounts paid in cash to buy inventories, but not counted as cost of goods sold. The next component is an increase in all other current assets except for your cash, and here this will vary. All right. Now, if you have a gain on sale of assets, this will lower your cash flow because it deducts the gain reported in net income that are part of cash flow from investing activities. Now, you have cash flow from operating. This is usually a positive number. You have proceeds from the sale of long-term assets and investments. This also is a positive because it's cash inflow that includes gains on the sale of an asset or investment. Next, you have capital expenditures. This normally lowers your cash flow. It outlays for property, plant, and equipment and other investments. Next, you have an increase in all other long-term assets. This also will lower your cash flow. It outlays for PP&E and other investments. Now, you can also get cash flow from investing. Now, this is usually a negative number. You can get an increase in bank loans. This is a plus because it's the net capital raised from negotiated debt. You also can get an increase in long-term debt. This is also a gain because it's a net capital raised from negotiated debt. Your next is an increase in preferred stock. This will also add to your cash flow because it's net capital raised from issuing new preferred and common shares. You have increase in paid-in capital. This also is an addition to your cash flow because this is net capital raised from issuing new and preferred common shares. Next, you have increase in treasury stock. This normally lowers your cash flow because these are payments for repurchasing common stock. Next, you have dividends paid. Of course, with the words paid, you can assume this is going to lower your cash flow. So again, this is a payment to preferred and common shareholders. Next, you have cash flow from financing. And this can either be a positive or negative number. And lastly, you have an increase in cash and cash equivalents. Now, there must be an agreement with the net change in cash and cash equivalents on the balance sheet.